Stocks continuing to struggle after yesterday's slide. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off this week, and Bloomberg Open Interest starts right now.
Coming up, Wall Street remains on edge. Investors waiting for NVIDIA earnings and further clarity on the AI boom. And a heavy slate of eco data this week, also adding to the wait-and-see mood. Next hour, we're going to get the latest read on consumer confidence. Plus, IPO hopefuls face a tough choice. Take the leap, go public this fall, or wait until next year when risks may subside. We'll discuss that dilemma later this hour. Meanwhile, let's take a look at where markets are trading. About 30 minutes to go until the cash open. You can see not too pretty behind me. Of course, you have the S&P 500 down about 0.3% pre-market. You take a look at the NASDAQ 100 down nearly 1% yesterday, continuing that fall today, down about 0.4%. Meanwhile, a little bit of a sell-off in the bond market, not the haven-seeking bid you might expect to see. 10-year Treasury yields currently up about 4 basis points, Sonali.
It's interesting. It's a reversal from what we've seen the last couple of weeks, but we're also watching some individual stocks, some pre-market movers on our radar. Kava now under pressure after the chain's largest shareholder and a group of investors filed to sell shares. Kava shares down pre-market more than 8%. The stock soared around 25% last week following earnings and bets on interest rate cuts. We're also watching Skydance Media set to become the new owner of Paramount by mid-2025. Edgar Bronfman Jr. has dropped his bid for the media giant. And of course, you now have Paramount Global still down about 4.3% pre-market. Remember, they have scrapped their Go Shop provision at this point. We're also watching Amazon. The company signed a $100 million deal for the Kelsey Brothers podcast. The 3-year deal includes advertising and merchandising, and Amazon down 0.3%. But of course, Katie, we've seen weakness in big tech this week so far overall.
Yeah, that is super interesting just on that podcast news. Similar to what we saw last week, of course, with SiriusXM and Alex Cooper of Call Her Daddy fame. A lot of interest and intrigue in the podcast industry right now. But let's switch gears, get back to markets, because joining us at the desk, I'm thrilled to say we have Rebecca Patterson. She is former chief investment strategist over at Bridgewater Associates, now joining us. And we were chatting a little bit before the show started how we're at this interesting in-between period. We're past Jackson Hole, it's before NVIDIA earnings, and it's before September. Interesting to see markets kind of on a downdraft, even after Jerome Powell basically said last week, I'm going to cut interest rates in September.
Yeah, I mean, I think it makes sense that we're consolidating a little bit and even giving back a tiny bit. Remember, we're in a period right now where the liquidity in the markets is not robust, let's say, and so it doesn't take a lot of selling to pull things down a bit. But with so much priced in for the Fed now, you know, we have between 1 and 2 25 basis points cuts priced in for September, 100 for the end of this year. And then if we look out to the end of next year, over 225 basis points of cuts priced in. So it makes sense that lower interest rate environment, that's now largely discounted into market valuation. So we need a new catalyst, and that catalyst could come from some of the economic data we get this week and going into September. It could certainly come from earnings tomorrow or in the days ahead. But we're kind of waiting for that now.
Well, just focusing on the Fed, we were discussing a little bit yesterday how it seems like the markets and Fed policymakers are more closely aligned than they have been over the course of the past year or so. When you take a look at the economic data, at signals we could get from Fed speakers, is it maybe a more open door to 50 basis points in September, or maybe more interest rate cuts overall that would finally push us to all-time highs?
I mean, again, a lot is priced in on the interest rate side. So personally, I think the data will matter. The Fed's right. They are data dependent. And so if we got soft jobs numbers, if we got more disinflation coming through, bad consumer confidence, we have numbers coming out later today, that could push the Fed to a 50. Personally, I'm on the fence whether we get 25 or 50 at this next meeting. They're very restrictive now. So just to get closer to neutral on interest rates, they could decide to do it a little faster and get to 50. But at the same time, they're watching, how much is the consumer slowing? How much is the labor market slowing? What kind of financial conditions easing is passing through? And so I think they're going to want to pace it sort of carefully till they see how this is feeding through. And that's going to take a few months. So I guess I'd be leaning more towards 25 and a measured pace while they're watching the data and how it's feeding through.
You know, because it's been such a big topic of discussion this year and a big element of uncertainty, let's talk about the consumer scenario plan a little bit, because we have that consumer sentiment data, like you said, at the top of the hour. We have University of Michigan data at the end of the week. We have a ton of retail earnings. Even if you get 25 or 50 basis points worth of rate cuts, how much does that improve the consumer story given the lags that there are after you see those cuts?
I think this is such an important thing, not just for the Fed, but for all of us who are watching the markets and investing in markets, because as people priced in an easier Fed, they've also been pricing in a greater chance of a soft landing. And we've seen that reflected in small caps, in regional banks, in commodities, in emerging markets. All of those things are benefiting from a weaker dollar, which is coming from Fed expectations and hopes that the Fed will be enough for the consumer. And I think it's a big question mark. Does the transmission mechanism from the Fed to the consumer work this time? Remember, about 60% of U.S. mortgages right now are locked in at 4% or less. So even when the Fed starts to cut rates, you're not going to see a bunch of mortgage resets that create consumer wealth overnight. So yes, there's going to be transmission to the equity markets, to wealth that way, but it's not going to be the normal channels we've seen in decades past. So it's a question to me, can they get the soft landing? I'm still on the fence about that.
How much transmission, though? Because you think about it, and fine, maybe some of that cash on the sidelines might move to equity markets. But given how much big tech, AI, NVIDIA has been propping up this market, if you still have weakness in the consumer and the sector lags, can you really see significant gains in the S&P?
I hear you. I mean, personally, I'm structurally bullish on tech. I appreciate that the valuations and the crowded positions, less so today, but still there, make those stocks vulnerable to any disappointment. Even if revenues beat, if guidance is soft, you can still get some pullbacks. That's important. But longer term, these companies have such a comparative advantage, incredible free cash flow. They have the ability to invest in themselves and continue to innovate. So if I see a dip in those stocks, I'm a buyer. I want to stay invested. But for the consumer, things like small cap, that rotation, it's not enough to have lower rates. You also needed to see stable or ideally improving growth. I'm kind of skeptical that growth's going to improve that much just on the back of the Fed cuts.
Well, let's keep the conversation going specifically on big tech, because we have NVIDIA reporting after the bell tomorrow. You take a look at what's priced in, about a 9 to 10% move. That's in line with historical averages. And it just feels like, compared to maybe 3 months ago or their earnings report before that, when it was billed as the most important thing to ever happen, there's a little bit less anticipation, a little less fanfare around this one. What can we take away from that, extrapolate out from that when it comes to the mood of this market?
I think part of the less myopia on NVIDIA is because we've had a bit of a rotation already. If we look at the month of August, we have seen things like the equal-weighted S&P do significantly better. So people have been broadening out their positions across sectors, across types of stocks, and I think that takes a little bit of the onus off of the single magnificent 7 names, if you will. It's still going to be important, obviously, in a low liquidity environment this week. If they have a strong or a weak result, especially on the guidance, it's going to move the market for a day or two. Again, my view is keep an eye on the bigger picture. Do we think AI is going to continue to broaden its impact? Do we think, in this case of NVIDIA, the demand is going to continue to outstrip supply for its key chips as we go into next year? That was their guidance at the last report they made earlier this summer. Let's see what they say this time.
If you take the last month as a sampling of that broadening out trade that we're talking about here, you see consumer staples, you see real estate, you see utilities really leading that list here, some of the dividend payers as well. Is this indicative of the type of broadening you might see through the rest of the year, or is this just a short-term play on potentially lower rates?
Right. And well, lower rates I think we're going to get. The question is, do we get as much or more than is already discounted? The thing that I'm more skeptical about is the other piece of the soft landing, which is, are we going to see a strong consumer continuing to support earnings? Utilities is kind of interesting because it can also be a defensive play. If the consumer pulls back, the AI story remains intact. We continue to need more energy. So that's something that probably is a little more perennial, if you will. But some of the other consumer plays, again, especially going into things like small cap or regional banks, I think they really require better growth, better consumption data in the quarters ahead. it's not clear to me that the Fed cuts will be enough to generate that.
That's interesting, and of course you're sticking with us, but before we go to break, I wanted to talk specifically about size. That was, a beautiful chart showing us the broadening out among sectors, but when it comes to the small caps, I'm glad you brought them up because that's one of the debates, whether Fed cuts will be enough. And, you talk about this path down to neutral, but there's the idea out there that neutral is higher than what it used to be.
Absolutely. I think it is, without a doubt. And so what I think often happens is investors will look at historical patterns and they'll say, okay, when the Fed started cutting interest rates, that was usually close to the bottom for the economic cycle, the business cycle, and small caps, because they're less liquid stocks, tend to move faster as we go through that turn in the beginning of the economic upturn. But we're not in that place right now, right? We're not in a recession. We're actually in a decent economy. And so are we going to get the turn in the economy with the amount of force that you would in, say, a 2009 or even a 2001, 2002? It's very different this time with the consumer and with everything else. The one thing small caps have, incredibly cheap still today valuations, very underowned. So it's worth looking at them. I just don't know if the growth catalyst is going to be there. So my view has been, continues to be, don't ignore them, don't avoid them completely, but this is a time to be active management, very selective. I would not be buying a broader small cap index, broader EM index, any of those soft landing plays. You need to be stock picking right now in those areas.
All right, Rebecca, we're just getting started. Sit tight for a couple minutes. That, of course, is Rebecca Patterson sticking with us. Let's take a look at futures right now. Of course, as losses deepen pre-market, the S&P down about 0.3% pre-market. The NASDAQ 100, your big tech names, down about 0.4%. And that rotation that we were talking about, not exactly happening today. The Russell 2000 futures currently down about 0.8%. This is Bloomberg.
Now to high interest, a look at what's making headlines around the world. Longtime Apple CFO Luca Maestri will step down from his job at the end of the year. He will be replaced by his top deputy in what's being described as a planned succession. Maestri will remain at Apple in a reduced position. And remember, Apple also announcing its latest product launch event on September 9th, expected to announce details of the iPhone 16. And Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients for a discount as it tries to address supply shortages. Patients with a prescription can purchase a month's supply of single-use vials through Lilly's website starting today. Zepbound is sold as an auto-injector pen. With vials, patients need to fill syringes on their own, but it saves Lilly production time, allowing more patients to get the drug. And Meta CEO Mark Zuckerberg alleges that Facebook was pressured by the U.S. government to censor COVID-19 content during the pandemic. In a letter sent to the U.S. House Committee chair, he said senior officials, including some from the White House, had pressured Meta to remove content in 2021. Zuckerberg joins other social media executives in lamenting past instances of content moderation that, in their view, went too far. Katie.
And we're back now with Rebecca Patterson, former chief investment strategist at Bridgewater Associates. And let's stick with politics because we've talked about the Fed, we've talked about earnings, and you were actually at the DNC last week. Tell us what the vibe was on the ground.
Yeah, so I was invited to speak on the sidelines of the convention about economics and policy. And, just like you all want to talk to your sources, security analysts want to go talk to company management. This was an opportunity for me to be on the ground, to talk to policymakers, talk to executives, and get a better feel of what kind of policy we could get if Harris does become our next president. What struck me more than anything about this event, and this was the first convention I've ever attended, was the amount of very senior level corporate interest in the policy proposals of a possible Harris administration. It was much more business forward, business friendly than I think sometimes the mainstream media might portray it.
So to that end, you did have Harris initially put forward this price gouging ban. There are a lot of worries among the C-suite here that the taxation policies will be much more stringent, particularly as those Trump-era tax cuts expire. Why exactly do you see a path in which she might be more friendly to corporations than meets the eye?
Yeah, so the price gouging proposal, it's important to note that price gouging bans already exist in 34 states. So this isn't anything new. And it's not clear to me exactly how it would be implemented, if it could even get passed. I think the bigger picture here for Harris, and this is just my own speculation, is that they're trying to do what they can to help families that have not participated as much in this economic recovery. And a lot of that is prices. So what can they do to increase supply of homes, to reduce home prices possibly, or make it easier for those people to buy a home, to make sure they can afford their groceries, et cetera. So how often are they going to implement price gouging? Maybe never, given that grocery prices are now starting to come down a little bit. But it's just a signal of we're out there, we're trying to take care of you. But I think the more important thing I heard, when we think about taxes, when we think about investment, what I heard from policymakers and people thinking about policies for Harris is really a pragmatic approach. What do we need to do to take care of the economy and everyone in it? And so, yes, we may need to raise taxes because we have this incredibly large debt and deficit thing hanging out here. So we can't just have unfunded tax cuts. But anyone with an income $400,000 or lower is getting tax cuts or no tax increase. So there's gives and takes. I think the big takeaway from me is that when we, you all reporting, me investing, researching this, look at this, don't take any one policy in isolation. And I know you don't. We have to look at the aggregate picture. So price gouging is this one tiny little dot that people make a big deal out of, but you have to look at the policy platform in aggregate, and then remember that policy is one part of the picture. We also have to think about monetary policy, growth outside the United States, and what's happening at the bottom-up level. What are companies doing? What are industries doing? All of that is going to tell us how to invest, not any one given policy.
Well, I want to extend the timeline because, some of the conversation about how the candidates relate to markets can be very short-term in nature. We talk about the Trump trade, we talk about the Harris trade, but when you consider their policies holistically, what they've put forward so far, how does the Trump investment differ from the Harris investment landscape?
One reflection I've had as I spend as much time as I can understanding how their policies, if they get enacted, could affect the economy and markets is that, in general, and this is a generalized comment, I find that a lot of the Republican proposals are broad, blunt tools, broad tariffs, broad tax cuts. And that's neither good nor bad, but they're hoping that this broad approach will get the result they want. The Democrats tend to be, instead of a sledgehammer, a scalpel. We want to make investments, but we don't want to spend more than we have to given the deficit. So let's give money to strategic industries where we need more secure supply chains, where we know we can create manufacturing jobs. And so there's different approaches. The tricky part with the scalpel approach, for example, the Inflation Reduction Act, the CHIPS and Science Act, is for those things to lead to economic growth and jobs takes years. Right? It's no sugar high for a manufacturing worker or the economy, whereas I'm cutting taxes by this much this day, that's a sugar high. And so there's going to be differences in how quickly you feel the changes, and there's going to be differences in the unintended costs and risks from the two policies.
Well, Rebecca, I'm going to ask the cheaper question here because we could think about those long-term investments, but there's so many people out there trying to understand the trade.
Yeah.
How do you wrap your head around the Harris trade?
So I think for shorter term investors who are saying, okay, we're getting close to November, how do I position for that? First of all, don't position till we're in October. 70 days or so we have left till the election is a lifetime. A lot can change between now and then. So I would not be positioning yet. I would be thinking about scenarios depending on who might win, Trump, Harris, and the possibility we don't know the winner or the congressional makeup for maybe a few weeks, especially on the Congress side after the election. And so you don't want to put all your eggs in one basket. I would be looking at policies between the two candidates that are likely to work either way. So, for example, something like defense, bipartisan support to keep defense spending going. Something like energy. Now, Harris is much more focused on clean energy, but they're not giving up on fossil fuel. They can't, right? For us to make that transition smoothly, you're going to need fossil fuel for some time. So, and natural gas is a cleaner fuel in that front. So I think that there are sectors that are likely to play well, almost regardless who wins. if I were going to do a shorter term trade on the election, that's what I would be doing right now, trying to find those small slices where the two candidates' policies actually have something in common. And there are a few of those places.
And wait until October.
Oh, gosh, yes. Oh, my gosh, yes. It's way too, I mean, think about Hillary Clinton. I mean, until October, people thought she was by and far the winner and she was going to beat Donald Trump.
Yeah.
And everything changed in a matter of weeks. And people who bet on one outcome too early got burned. Likewise, Donald Trump, everyone thought trade war, it's going to be horrible for the U.S. economy, horrible for the U.S. stock market. That trade lasted a few hours. Right? So you need to be very careful not to overplay the trade regardless of who wins and what their policies might be.
We'll be having to have you back a lot more closer to that date. Former Bridgewater Chief Investment Strategist Rebecca Patterson, we thank you so very much for your time. Also bringing you some breaking news because Supermicro shares are dropping 8% pre-market on a Hindenburg short. Hindenburg posting on their X page and their website, Supermicro, providing fresh evidence of accounting manipulation, sibling self-dealing, and sanctions evasion at this AI high flyer. Remember, Supermicro is a stock that has risen about 100% this year ahead of this short being announced. Stick with us. This is Bloomberg. We'll bring you more as it comes, including their response if they have one.
All right, we are moments away from the start of trading. Of course, as we wait and see for NVIDIA earnings coming up tomorrow, you can see futures right now a little bit depressed. We had a rough day yesterday. Looks like it will continue today. Of course, the S&P 500 down about 0.3% pre-market with just seconds to go until those bells officially ring and the market opens. You can see on the NYSE, we have ING Academy on the NASDAQ. It's a community bank from Ohio. We're thinking of Matt Miller, Middlefield Bank, ringing the bells. Of course, as we kick off trading on this Tuesday, you take a look at where markets are opening up. You can see the S&P 500 down 0.2%. Big tech, those are yesterday's numbers, but you can see they were falling 1% yesterday. And as markets open right now and the board flips up, continuing that downfall today, down about 0.3%. And the Russell 2000, not too pretty for those small caps, currently down about 0.5%. But one stock specifically to keep an eye on right now, shares of Paramount falling. Skydance set to become the new owner of the media conglomerate. That's after Edgar Bronfman Jr.'s group dropped out of the bidding war after submitting a $6 billion proposal last week. Paramount now expects to complete this deal with Skydance in the first half of 2025. And maybe then, Sonali, we can stop talking about it.
Maybe then, maybe not, though, knowing how this has been going. Also watching shares of Supermicro also dropping. Hindenburg says it's shorting the company. Bloomberg is reaching out to Supermicro for comment. Supermicro now down more than 7% at the market open. We're also watching Cava because the restaurant chain's largest individual shareholder and a group of executives filed to sell shares. And remember, Cava has been on a tear this year. Since last week's earnings, 10 analysts raised their price targets by an average of 23%. Yet on that share sale, you have Cava now falling more than 7% this morning as well. Let's take a closer look at Cava with Bloomberg's Abigail Doolittle.
And this is the worst day for Cava, Sonali, going back to February of this year. So some significant selling, lots of mixed messages around this stock and the company. Now, if we take a look at the sale, I think that one reason that investors in the stock, retail investors, institutional investors are concerned about our tail selling. They actually sold a pretty decent chunk back in June. They sold 3 million shares. That was worth about $267 million. Well, now they filed to sell 6 million shares. That's about 8.6% of the equity float into this, holding about 20.5% of the equity float so a pretty significant amount. Investors wondering what's going on here. Are they really shaving? Plus, there were some of the executives within Cava itself, the Mediterranean fast food company, including CEO Brett Schulman, did also file to sell shares. However, before we start feeling too bad for investors in Cava, although it does, of course, depend on where you bought, if we take a look at these shares out of the IPO, this is really pretty incredible. So we think that of NVIDIA as being parabolic. If we go back to Cava's IPO all the way back in June of last year, in white here, even with today's dip, and technically this does not look good, this is a parabolic uptrend, the reversal. We will reverse it all the way well back back below 400. Remember, 90-degree angle can't hold. But there is NVIDIA in blue, and actually above that, sweet green, and then Chipotle down in yellow. So some of these newer restaurant companies, they're taking on the AI craze, Katie.
All right, there you have it. Abigail Doodle, thank you so much. And let's broaden out this conversation now with Dana Dioria. She is co-chief investment officer over at Envestnet. And I want to go to your notes because you write that earnings are cooperating, but the only notable company that is yet to report, of course, is NVIDIA. And that feels like a big but, to put it mildly, Dana, because NVIDIA, I mean, second largest company in the S&P 500 by market cap, move of 10% priced either way. What do you think the stakes are when it actually comes to this company?
Yeah, also a huge contributor to earnings, right? For the overall S&P, I mean, close to 5% contributor on the earnings side. So yeah, there's no question that, we're past the FOMC meeting. That was sort of the big market moving event that we were expecting. But the NVIDIA announcement coming is certainly going to be the next one that we can look toward. And, it's not just about, of course, NVIDIA itself, right? And the earnings contribution and, its market cap weight. It's, of course, a bellwether on how the AI trade is going. And we're seeing lately a little bit of a pullback on tech, right? The equal weighted index doing much better. And so I think, there's going to be always an NVIDIA, not only for the company itself, of course, but just for how well are we doing in this AI trade.
Well, you think about some of those big tech earnings that didn't go over so well in early to mid-July. And one of the criticisms, of course, was that basically they're spending so much money on AI and not getting anything back. But then you take a look at the companies that are taking in that money, and it's NVIDIA. I mean, 19% of their revenue comes from Microsoft alone. So those billions of dollars that are being funneled to AI, that just feels like NVIDIA's benefit here.
It is. And right now what we're seeing, of course, is that the AI craze is really sort of focused on the creators, right? If you will, the NVIDIAs of the world who are going to deliver us the components we need to use AI. We haven't yet seen AI in any way kind of break out into or user experience, right? And how, big companies pointing to our productivity increased dramatically. You get a lot of talk of AI in earnings announcements, and just for the sake of, hey, we're looking at this, or we've experienced some benefit here. But there's big differences in how companies are using AI, and we have yet to see a really big move in terms of just productivity increase or efficiency increase, or the benefits of AI to the users. And that's why so much towers on the NVIDIAs of the world now. But these big tech companies investing here, they're self-funding, right? They can certainly afford to accept a little bit of a dip if they see the long-run thesis, and clearly they do.
It's interesting. We had a conversation with RBC's Amy Wu Silverman just a day ago, and she made this point that there has been such extreme bullishness in NVIDIA that even a little less bullish means that it could say a lot for the market, that people are excited, but maybe not as excited as they were when valuations were a little lower or when the market was a little less choppy. Now, at the end of the day, if that's the case, then is NVIDIA really a story that could prop up more boats and lift this market higher with it?
I think if NVIDIA does well, it does lift boats for sure. There's two things going on here, right? There's the short run. How is NVIDIA doing in this moment relative to expectations? How has the market perceived that? And when your valuation is so high, any little bump, 100%, right? In the short run, any little bump is going to be negative, not only for the stock, but for the market overall. That's a very different question than what is the long run thesis for AI? Are we well on our way? Is NVIDIA one of the companies, not the only company, but one of the companies that's going to get us to this huge revolution, right? And change in how we all do business. So, I mean, the short run, absolutely. They got to hit it spot on, right down the middle in terms of, the pitch, right? But at the end of the day, this is just a short run kind of a market, assessment of, have we overshot right now? It has nothing to do with the long run thesis here.
Well, that was my question. Why not wait? It's interesting. If you take a look at the Philadelphia Semiconductor Index, for example, just year to date, NVIDIA up more than 150%. It's really up 154%. To get to the next best performing stock, it's Coherent at about 80% on the year. Why not either look for stocks that are sitting at lesser gains, better valuations, or just wait for a steeper downturn to get in?
I think that is the right thing to do for the average investor, right? I mean, I think the average investor is, they're either, if they're passive, they're getting a ton of NVIDIA. Even if they're active, unless they're taking massive tracking error to the index, they have a whopping amount of these types of companies, NVIDIA's and, the big tech in their portfolios already. So 100%, and as we see the equal weighted S&P making new highs, all the more reason that, what you're asking, I think, is 100% valid, that for the average investor, tilting away from this a little bit is probably the smart way to go, even if you believe in the long run AI thesis.
Dana, we have to leave it there. That's Dana Dioria of Envestnet. We thank you so much for your time ahead of a very critical set of earnings this week. And of course, there's a lot of economic data this week as well. Now, coming up, we're going to talk to Bob Sloan from S3 Partners to discuss the market implications of NVIDIA earnings tomorrow. We're going to also talk about the market for going short here because, of course, you have some prominent names betting against some high flyers. We're going to talk about it next. This is Bloomberg. This is Bloomberg Open Interest. A quick check on stocks because we're having a tough tape today. We are seeing the S&P 500 holding on to losses today of 0.3% and deeper declines in the NASDAQ 100 of 0.6%. That small and mid-cap index, that Russell 2000, the once beloved index this year, now seeing some pain as well, 0.7% lower. Really that optimism around interest rate cuts fading in the market today, Katie.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Citi says to sell Hershey, downgrading the chocolate maker from neutral and cutting its price target. The analyst sees a challenging year for Hershey and says that its pricing plans for next year won't be enough to offset the high cost of cocoa. Next up, you have Seaport raising Cleveland Cliffs to buy. The analyst says that the firm is well positioned to respond to a down cycle in steel prices and adds that the upcoming conferences will improve sector sentiment. And finally, we have Morgan Stanley raising its price target on Coca-Cola to a street high of $78, naming it a top beverage pick as well, replacing Pepsi. The analyst says the soda giant is posting healthier volume growth than its peers and highlights the company's strong pricing power, Sonali.
And all eyes on NVIDIA this week ahead of earnings tomorrow. S3 Partners founder and managing partner Bob Sloan joins us, and his team notes that NVIDIA remains one of the largest positions in both the long and the short side of the market. Actually, the most shorted semiconductor stock with over 4 times the short interest of Broadcom. You write, Bob, tell me about this data that you're seeing here. What exactly is driving the short interest here? Do you understand if it's really about valuation concerns mostly? And do you think that short interest is sustainable given the run-up we've even seen this year?
Well, one of the things we've seen in our short interest data is the following. Shorts started the year at $13 billion. They're now at $35 billion. New initiated shorts along the way of $3 billion. So you have the most new initiated shorts in the semiconductor sector, NVIDIA, $3 billion. The largest by far, both in the sector and across the industry and across the entire market, total $35 billion. Persistence of short selling and new initiation equals high conviction. And I think the analysts that you've had on your show, I was watching yesterday and today, have been talking about a near-term momentum reversal. That's what the short interest is betting on.
And Bob, of course, NVIDIA has become more and more important to the market, of course, as that AI story really takes hold and this company becomes bigger and bigger. How does the short interest dynamics against the long side that we're seeing ahead of this earnings report compare to previous quarters?
Katie, it's a great question. So for the first time really ever, you can, by using our data, you can break down market structure. Now, who cares about NVIDIA? Everybody. If you're a passive investor, it's your second largest holding across the market. If you're an active long manager, it's your third or second largest holding across the market. If you're retail, it's probably your largest holding. If you're a short seller, it is the largest holding, largest bet. So everyone around the table has a stake in NVIDIA. And what our data is telling us is that The long holders are trimming just a hair, just a hair. The passive investors are trimming by about 2%. The active managers about 7%. Short sale sticking in. So you see a little bit of long selling, persistent short selling, and that's why we think the market's set up for a near-term momentum reversing. These stocks are unicorns. NVIDIA, you don't see this very often, where it's the largest long position in the marketplace, and it's the largest short position. So it's happened maybe like 4 or 5 times in the last 30 years. And the reason why is because it's this incredible utility combination of high beta, high vol, high liquidity, and cheap to get in and out of, both shorting and long.
Bob, you know, one thing we were talking about a little earlier as well that I'd love to get your insight on is NVIDIA has risen a lot more than what you've seen in the rest of the Philadelphia Semiconductor Index. So when you look at investor attitudes towards other AI-related companies, given the run-ups we've seen in many of them, do you see similar levels of short interest outside of NVIDIA?
NVIDIA dominates. It's a third of short interest in the semiconductor sector, and it's the largest short, period, across the marketplace. The rest are just add-ons.
And it's interesting, of course, that dynamic that we've been talking about, that you have interest both on the long side and on the short side. You're seeing it, too, if you take a look at some of these leveraged single stock ETFs. You have shares outstanding both in the 2 times long and in the 2 times short products. So it's interesting to see that match up with your S3 data as well. And one of the narratives I remember, especially around Tesla, was that it's impossible to short. You just get burned and burned. How much money, just roughly speaking, have short sellers actually lost when it comes to NVIDIA?
Yeah, about $22 billion. And
wow.
So that's a great point. It's about high conviction, taking losses, but taking the pain and staying in the trade. And not usually you see with the Tesla, the difference was that you'd see older shorts get replaced by newer shorts and get taken out. We're not seeing that. There's a real persistence. And, you know, there is some, I would say, maybe market euphoria is having dessert and it's calling for the check.
Bob, thank you so much for joining us. That is Bob Sloan of S3. And don't miss an exclusive interview tomorrow with NVIDIA CEO Jensen Huang right here on Bloomberg TV at 6:30 p.m. Eastern. And coming up, we're going to talk about IPO hopefuls. They're facing a tough choice. Take the leap and go public this fall, or wait until next year when risks may subside. We're going to discuss the dilemma next. This is Bloomberg.
All right, this is Bloomberg Open Interest. Let's take a quick check on stocks right now. Companies are itching to go public, but the market hasn't exactly been fruitful for that. You take a look right now, the S&P 500 down about 0.2%. The NASDAQ 100 even more, down about 0.4%. That's after yesterday's slide, of course, down nearly 1% yesterday, continuing to fall today. And the Russell 2000, things are getting ugly over there in small cap land, down about 0.7%. Of course, we're in that interesting vacuum, Sonali, after Jackson Hole, but before NVIDIA earnings and, of course, before the Fed's September meeting.
There's another window we're going to talk about also. It's that IPO window, because companies itching to go public face a really tough choice here. The fall IPO window is now open, and you can either take the leap with markets near all-time highs or wait until next year when risks around interest rates and the U.S. election have faded. For more on this dilemma, we're joined now by Bloomberg IPO reporter Bailey Lipschultz, who has been writing about this dilemma all year long. And you look at what has happened this year so far. The companies that have gone public, even the ones that have hit potholes along the way, are still higher than their IPO price. Why not just take the leap right now?
Well, that's the big argument, is why not? If you look at Viking up 50%, you look at Lineage, the biggest offering of the year, raising more than $4 billion in the REIT space, up about 10%. Investors are being rewarded, but a lot of founders and boards raised cash in 2020 and 2021 at far higher valuations. So now you have to have that conversation about what are we actually worth and what kind of a discount do we need to give investors to buy the IPO so that we can talk about being up 40 or 50% as opposed to being, you know, like a company that's like Rubrik, which is up 11%, even Astera Labs, who went public last year, which is closer to unchanged after almost doubling in its first day.
And so I get the thinking that, okay, if we're not going to go public by November 5th, maybe we just wait until next year. But you think about some of the risks on the table. Do you think that the landscape will have meaningfully changed in 2025? What's the logic there?
Well, when we sat down with the heads of pretty much every bulge bracket bank last year in November, the conversation was, 24, we're going to have 4 or 5 rate cuts. We're going to have some election risk that'll eventually kind of play itself out. It feels like we're having that same conversation. Yes, there is a timestamp for the election, so we will most likely be kind of moving on from that risk come January, February. And we are expecting, as you guys have kind of talked about, the Fed to cut in September, and potentially, at least when you look at the swaps market, potentially the next 5 meetings. But the big question is, will those interest rate cuts play out? How will investors react to a potentially riskier environment? And how does that impact some of the valuations that a number of these companies that have been waiting to go public, trying to kind of tease out what their actual valuation would look like? Their view is that they'll have a better kind of line of sight come March to May.
You kind of have to also think, I think, about who benefits if you kind of go public at top dollar, right? I mean, there's certain investors who do benefit, but plenty who don't. A lot of employees have stock in these companies that want to continue to see those companies do well. Is there a benefit, actually, to wait and see if valuation's correct?
Well, it really depends who's selling. And there is kind of just that argument that taking a perceived down round can hurt some egos and hurt some expectations, or even just hurt morale. If you raise cash and you're an employee and you were worth $60 billion and you go public at 20, then you're looking at your options saying, well, this isn't really what I signed up for. But on the flip side, if you go public and only sell a small chunk of your stake, and 6 months from now, if you're a private equity sponsor, you can start capitalizing. Or if you're a company like Kava that's up 400%, that's a still hefty return that maybe when you went public at the IPO, you weren't as excited about that price and valuation. But if you continue to execute and don't have missteps, you're going to be looking better in the end.
All right, Bailey, like 45 seconds. We're talking, of course, a lot this year about that dearth of IPOs. But I thought this was interesting under your byline this morning, a SPAC. I haven't heard that phrase in a while. Yeah, let's talk about it.
Yeah, so Bob Diamond and Concord had launched 3 SPACs. This is the last remaining pre-deal SPAC, but no more, announcing plans to take Events.com public. So Bob Diamond, former CEO of Barclays, a lot of excitement around that name, and his firm Atlas. So this deal, which we broke overnight, is going to value the company north of $300 million, depending how you want to tease that out. But another SPAC deal in what's been a really boom or bust, primarily bust space in the last few years.
All right, Bailey Lipschultz, really appreciate you stopping by. Of course, he covers IPOs, equities, and everything else. Let's get you to the trading diary. What you need to be watching this week today. We get Nordstrom earnings after the bell, really kicking off a string of retail earnings this week. But the big event is tomorrow, of course, when we get earnings from NVIDIA after the bell. All eyes on those numbers. More retail earnings from Kohl's, Abercrombie & Fitch, and Five Below coming up on Wednesday as well. Thursday, initial jobless claims, and Friday, we get July's PCE inflation data. Now, coming up in the next hour, we're joined by Zillow's new CEO, as well as Mark Patricof. That's, of course, as the NFL votes on private equity ownership. This is Bloomberg. We are 30 minutes into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off this week. And coming up, Wall Street remains on edge. Investors waiting for NVIDIA's high-stakes earnings report and a heavy slate of eco data this week. And taking the reins at Zillow, Jeremy Wacksman joins us to discuss his efforts to grow the business despite a historically sluggish housing market. And are you ready for some football? We're going to talk money, power, and sports as the NFL considers private equity ownership, Katie.
And before we get there, let's get a quick check on these markets. Of course, 30 minutes into the U.S. trading day, as I mentioned. We're still in the red, but not by as much. The S&P 500 down about 0.1%. That's following yesterday's slight fall. The NASDAQ 100, a little bit more. Your big tech names down 0.2%, of course, after yesterday's 1% slide. We have NVIDIA earnings tomorrow. How many times am I going to say that? That, of course, could completely shift the narrative, but that's the setup right now. Meanwhile, you take a look at the bond market. 10-year Treasury yields a little bit higher, drifting about 4 basis points to the upside, Sonali.
Well, pretty interesting. We have some breaking consumer confidence data crossing the terminal right now, and surprisingly, confidence better than expected, at least on the top line. Bloomberg's Michael McKee's here to join us to break it all down. Mike?
Well, it's not just the top line. It looks like people are more confident in general these days. The Conference Board's Consumer Confidence Overall Index rises to 103.3. That's from a revised 101.9. The expectation was just for 100.7. So overall, that is good news. The Present Situation Index, based on current conditions, improved to 134.4 from 133.1, and expectations also improved to 82.5 from 81.1. So across the board, much better. Now, the couple things I wanted to look at here, and I'm just dialing down to the overall numbers, which I don't have right here. But basically, what we're looking at is an overall improvement in confidence. And we have said this before, doesn't necessarily mean people are going to spend more money, but it does mean that people are feeling a little bit better about themselves and the economy. And that is probably good news for the Fed.
All right, Michael McKee out in San Fran for the moment. Really appreciate your insight, of course, as we parse through these consumer confidence figures. Let's broaden out the conversation now with Ann Miletti. She is head of active equity over at Allspring Global Investments. And, you know, Ann, I was going to ask you about the economy, what the Fed is going to read into it. But then I saw this line in your notes. You write that while macro news is stealing the majority of the airtime, the micro or company fundamentals matter even more at this point. I think that's really interesting because it's a debate we have all the time. What is actually driving this market? And when you take a look back at the past few weeks of earnings figures that we've gotten, what's the message?
Well, I think the message is a little bit mixed. Certainly the reporting season at the top line looks, actually, I should say at the earnings line looks pretty good, where companies are beating for the most part. I think over 80% of the companies that have reported so far have beat. But it's more important to us to look not just at the earnings line, but at the margin, at the top line growth as well. And there you're seeing a little bit more of a mixed picture. Also, you know, as you look at the outlook, which is the most important thing during earnings season, getting a chance to listen to the management teams and get their assessment of the outlook, that's a little bit more of a mixed picture too, just because there is more uncertainty and less upside potentially with margins.
Yeah, and you think about some of the huge numbers that these companies are putting up. I mean, NVIDIA tomorrow, by some measures, expected to see earnings growth, measures of earnings double, but that's compared to them growing by a gazillion% last quarter. It just feels like we could be setting ourselves up for disappointment, even though we're talking about huge, huge figures here.
Yeah, what's really interesting is we have this handful or maybe two handfuls of companies that have really put up incredible growth results over the last year plus. And those have translated to earnings, to margin, et cetera. But we all know that that fast of a growth rate is really difficult to maintain, especially the larger the company gets. And so we do expect to start to see some deceleration of growth. And I think there is fear in the marketplace, that will happen, and that maybe some of these multiples that we see in these larger, technology names, mainly the Meg 7, maybe just aren't that sustainable. Earnings still could look good, their growth rates could still look good, but it could be a deceleration from what we've seen. And that will cause some, dislocation, I think, in those names and cause investors to look more broadly at other names.
And at this juncture in the market, you are really looking at a market here that is figuring out which way to go. We are not too far from all-time highs, but we are struggling to reach them once again. Is there more upside risk or downside risk at this juncture?
I mean, I think that's the million-dollar question. I mean, I wish I had a crystal ball to tell investors this is what it looks like. I do think when, forget about S&P targets or, NASDAQ targets, et cetera, When I look across the board and I talk to our portfolio managers, what I really hear from them is there are attractive areas of the market. When you look at small cap relative to large, the gap in the multiples almost have been, historically has almost never been wider. You know, we've started to see small cap outperform for a short period of time, and then that kind of gets pulled away. You see that across the board in a lot of different areas. When you have the Russell 1000 growth, the top 10 names, comprise 60% of a benchmark like that. There's, again, it just talks about the concentration we're seeing in the market. And concentration, that does cause some areas of concern and some potential areas of risks. We saw that in the most recent sell-off. But what we're seeing more broadly in the recovery is a broadening out of the marketplace and a recognition that there are some areas of the market that are very attractive.
So you think about the broadening out and you think about why there's so much concentration in the first place. Think about the consumer worries as one of those fears underpinning a lot of that avoidance of certain sectors. And then you look at consumer confidence data like you do today and you wonder, Ann, how much more good data do you need to become a believer in a bigger broadening in this market right now?
Yeah, it's a great question. And I think the real challenge that we have today is that there's some uncertainty in the outlook. We are in an election year, which is typically good for markets, but uncertainty over what tax policy will look like, what regulatory outlook will look like, that's uncertainty for even management teams that are trying to manage these companies. And so investors and even the management teams of the companies are a little bit, at odds about what could happen as we look forward. That being said, I still think, investors should stay the course. Equity returns historically have shown that if you stay invested, you will get rewarded. If you go back the last 12 presidential election cycles, 6 Republicans, 6 Democrats, if you've invested $10,000 in 1961, granted a long time ago, but the compounding impact of that would be that value of that money would have been $5 million at the end of last year. So again, regardless of the uncertainty, there are places in this market to invest. And, you kind of have to ignore that macro noise and really focus on quality companies. And I think that's our, sharpest point right now here today, both in fixed income and in equity. You want to invest in quality.
Well, it's a good reminder, of course, that history is on your side if you're fully invested in the market. But you mentioned that uncertainty, and it might go a long way to explaining why there's still $6 trillion sitting in money market funds. There's a great story on the terminal this morning, the headline of which is T-bill and chill is a hard habit for investors to break. And I'll toss that question to you. What is going to be the catalyst for money to meaningfully move off the sidelines here? Are we just waiting for meaningful Fed cuts?
Yeah, it was a great article, by the way. I read it this morning. And look, investors were excited to see 5% returns on a money market fund. It has been a decent place for short-term money to sit and wait. But we are suggesting to investors, we know that, given what Powell said last week even, that the Fed is getting ready to start cutting. And so our fixed income teams would suggest that if you're in fixed income markets to start to extend duration, really start thinking about investing in bonds and lock in some of those longer term interest rates. And on the equity side, again, as we talked about, the historical returns are good. So I do think it's likely that move in the interest rate cycle that will get that money to move out of money market funds.
But how fast does it move? And at the end of the day, one other thing that a lot of investors believe will help move this market higher is that movement, right? Is that investor appetite to move out of the safe investments that are giving you a decent return here into more risky investments. But if the risk appetite is still so precarious right now, then how does that money really start to move?
Well, we'll start to get a little bit more certainty as we enter the tail end of the year. Certainly, again, it looks like we're going to get a rate cut in September, and then we'll get closer to the election. Hopefully, we will know who the president is in November, and we'll start to get a little bit more certainty around what the regulatory and tax environment will look like. And as we know, whatever the outcome, companies will adjust to that outcome, and that certainty will help, I think, start to get investors a little bit more comfortable with where they want to be longer term positioned. So I think it's going to take a little bit more certainty. We expect volatility to continue kind of through year end. And of course, I left out the macro as I focused more on the micro, but the macro data, we are not ignoring. It's certainly something our teams are paying close attention to. And I think the jobs data is something that is going to be critical, not only to the Fed, but to us as well, to signal, how secure really is the economy, and are we at risk of a recession? And potentially how deep could that recession get if we are going to enter one?
Yeah, absolutely. A lot of focus, a lot of questions on the labor market right now. Good place to end it. Anne Miletti of Allspring Global Investments, appreciate your time. Meanwhile, the S&P 500 basically back to unchanged. Let's get a look at what stocks are moving underneath the hood right now with Abigail Doolittle.
It's interesting. Beneath the hood, another tug of war happening between the bulls and the bears on a macro level. We'll take a look at that in a moment. But first, we do have at least two idiosyncratic movers to take a look at. First, Insulet, the insulin device, medical device maker. These shares are popping as the FDA has approved one of their technologies. Cava, on the other hand, as we were talking about the last hour, the Mediterranean restaurant, fast food chain restaurant, these shares lower as significant major shareholders are selling significant portions of their stakes. As for some of that macro play that I was alluding to, though, it really seems to be another day of investors moving toward value. We have Eli Lilly and United Health Group higher. Eli Lilly, of course, now selling some of their Zepbound for a significant discount. United Health at a new record high. Apple right now flipping higher. It had been down more than 0.5% around the news that their CFO, long-term CFO, is leaving. Amazon down 1.4%, despite the fact that they have this new Amazon podcast, or the podcast. They are signing the Kelsey brothers for $100 million. Maybe that is a piece of it, that money, but that's sort of a drop in the bucket for them. And then the big drag for stocks today was the big drag yesterday, which is the chip sector. If we take a look at what's happening for the likes of Supermicrocomputer and Broadcom, lower. Supermicrocomputer, Hindenburg has a short report out. And then the big one, of course, Sonali, NVIDIA, it had been lower earlier, now up 0.5% yesterday. It zigged and zagged. This, of course, is all eyes on this NVIDIA until they report tomorrow after the bell.
Abby, thank you so much. Of course, that is Bloomberg's Abigail Doolittle. And don't miss an exclusive interview tomorrow with NVIDIA CEO Jensen Huang, right here on Bloomberg TV at 6:30 p.m. Eastern. More up next, more on Zepbound's price cut, the latest on Eli Lilly next. This is Bloomberg. Now to high interest, a look at what's making headlines around the world. SpaceX delaying the launch of a rocket carrying 4 private astronauts to space. And it's part of a groundbreaking mission aimed at performing the world's first commercial spacewalk. The launch was initially scheduled for early this morning, but was scrubbed because of a possible helium leak. The launch window is slated for tomorrow. And the infamous pharma bro, Martin Shkreli, once convicted of securities fraud, has been ordered to turn over all copies of what was supposed to be a multi-million-dollar, one-of-a-kind Wu-Tang Clan album. He is also barred from selling or distributing the album thanks to a federal judge's ruling. In 2015, Shkreli paid a reported $2 million for that album, you may remember. And Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients for a discount as it tries to address supply shortages. Patients with a prescription can purchase a month's supply of a single-use vial through Lilly's website starting today. Zepbound is sold as an auto-injector pen, and with vials, patients need to fill syringes on their own, but it saves Lilly production time, allowing more patients to get the drug, Katie.
And let's take a deeper dive into that Eli Lilly story with the author. We're joined now by Madison Muller. She is Bloomberg's healthcare and pharma reporter, sitting next to me on set. So I want you to square this circle for me because, okay, they're lowering the price. Won't that just boost demand, and they're already struggling with making enough supply?
Right. It's a good question. The issue for Lilly, though, which maybe we've talked about on the show before, is the complexity of making these auto-injector pens kind of has bottlenecked supply. So that's been the issue for them. It's such a complex process that it's slowed it down a bit when demand, as we know, has been soaring. For Novo Nordisk, the supply issue has actually been making the active ingredient that goes into this pen.
Semaglutide.
Semaglutide, yes, exactly. You're a pro. So the problem's a little bit different. But for Lilly, this actually is expected to potentially be a positive to sales because they can sell more of the drug.
So what does this mean for the overall supply challenge? Because another thing we've spoke about before is in the race to get ahead on supply, Lilly has sort of been winning.
Yeah, exactly. I mean, I think this is another example. We saw Novo's shares fall this morning because they don't really have this same lever that they can pull when it comes to supply. I mean, doing something like this and offering vials isn't something that would help Novo when they just can't make enough of the actual drug that goes into those vials. So for them, they're still ramping up supply, building out more production capacity, as is Lilly, but they don't really have these same levers that they can pull on right now.
And let's talk about the competitive landscape, too, when it comes to pricing. Obviously, that has been one of the hottest button issues out there. Lawmakers, et cetera, everyone getting involved. You have Lilly lowering prices right now. What does that mean for Novo Nordisk?
Yeah, I mean, it puts more pressure on Novo. Lilly's drug launched actually cheaper than Wegovy to begin with. So Zepbound is about $1,000 a month. Wegovy's a little bit more. So you already had that dynamic at play, and now Lilly is offering this even cheaper version, which puts more pressure on Novo. It also puts more pressure on these copycat weight loss drugs that we've talked about, that people are seeking out these cheaper knockoff versions of the drugs, and now Lilly has this cheaper version that they're offering. So there's a little bit more competition happening there now, too.
Well, more on that. What does that mean for overall price improvements? We spoke to kind of a competitor yesterday to GLP drugs. We spoke to the CEO of Curax, and this whole idea of pricing is pretty paramount to someone like that.
Yeah.
What happens to the other drugs?
I mean, that's a good question. For Zepbound, it's actually not totally clear what's happening. We need to look into the data a bit more about how this affects average Zepbound price, because Lilly also did raise the price of a savings coupon for Zepbound either this morning or last night. They raised it by $100. So that's for people that have insurance, commercial insurance that doesn't cover Zepbound. It used to be $550, now it's $650. So there's a little bit of, kind of like a dynamic happening where Lilly's lowering the price, raising the price of the coupon. And so how that affects sort of overall prices is kind of unclear still.
All right, Madison, great reporting as always. Our thanks, of course, to Bloomberg's Madison Muller. On Eli Lilly, shares currently up about 1%, adding to a 66% year-to-date rally. Now, still ahead on this program, more on the arms race to sell pharmaceuticals directly to patients. We'll tell you about a new initiative from Pfizer in our Social Climbers segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The company is making waves this morning. And first up, Pfizer has a new plan to reach potential customers selling drugs straight to patients. The company launched a website earlier today that lets users schedule vaccine appointments or meet virtually with doctors. The website's called Pfizer for All. It's one of the ways that the pharma giant is trying to stem falling demand for its COVID products. Next up, Edgar Bronfman Jr. abandoning his pursuit of Paramount. Bronfman's decision to suspend his bid all but ensures that Paramount will be acquired by Skydance. The Hollywood studio reached an $8 billion merger agreement with Paramount last month, but that deal included a go shop window that allowed Paramount to seek other buyers. And finally, NFL brothers Jason and Travis Kelce today reaching a deal worth more than $100 million with Amazon for their New Heights podcast. The deal will run over 3 years, and Amazon's Wonder unit will have global distribution rights to all audio and video episodes. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. And Sonali, let's meditate on that a little bit. $100 million over 3 years. And this is after we saw that deal with Sirius and Alex Cooper last week.
And we could talk more about that. But what's fascinating here, too, Katie, is just how Amazon has been using Wondery. You may remember they valued the deal at $300 million when they agreed to buy Wondery in 2020. And so this single deal with the Kelsey brothers is a third of the total price for the podcasting platform, which is pretty incredible. It also comes on the heels of that Amazon NBA deal. So diving into that original content, intriguing but expensive.
I don't think I'm gonna become a professional athlete, but maybe we should just become podcasters. I'm starting to think that we're in the wrong business here.
Would love to hear about this. I think we would do a pretty decent job.
Yeah.
Maybe a little bit lighter on the sports content, but you could explain it to me.
That's true. I am not a huge football fan, but I will say this podcast, the Kelsey Brothers podcast, it keeps coming up on my TikTok feed. So I feel like a consumer of it. It's the same thing with Call Her Daddy. You think about all these different ways that social media has changed industries. I think it's been a boon for the podcast industry as well.
And for what it is worth for sports, I have just become a Packers fan. So hopefully that pays off for me this year. Anyways, let's get a check on these markets. It's been a tough tape. Of course, on light volumes, though, we have seen the S&P 500 now really turning green, but not by much. Light volumes once again, but we are pretty much flat on the day. The NASDAQ 100, that's an interesting little bit of a turnaround this morning. Now up about 0.2%. 10-year standing out at 385 after that consumer confidence data. Now, coming up, how many rate cuts will it take to reignite the housing market? We're going to ask the new CEO of Zillow, Jeremy Wacksman, next. Fascinating conversation. Looking forward to that one. Stick with us. This is Bloomberg. Jeremy Wacksman, the new CEO of Zillow, inherited a company that's been grappling with a sluggish housing market. We're going to get a closer look at that market with Bloomberg's Abigail Doolittle. Abby?
It may be a sluggish housing market, but you wouldn't know it taking a look at this board. But these, of course, the two first companies, Pulte and D.R. Horton. These are new home builders. So that new home market, those new homes, that's very vibrant because existing home sales really super low, just a stagnation in terms of buying and selling, as those who bought on super low mortgages, 2%, 3%, 4%, don't want to sell. So there's not a lot of supply. And then, of course, Zillow, the online real estate company, buy, sell, rent, and more, over the last year, also higher, up about 13%. But you can really see this gap between these home builders and then a company that focuses on some areas of real estate that are a little bit more traditional. Let's really put it into the perspective, though, of rates, because this does appear to be the big story here. If we go back to the GFC, we'll see on bottom this is the 30-year mortgage rate, and then you can see home building. Now, that, of course, was an unusual time period, but since that time period, as rates have stayed very low, home building taking off. However, right now, 7.3%, even home building, which has been pretty strong, a little bit of a struggle. If we were to put the existing home sales picture in here, it's basically down, down, down. So these higher rates influencing the real estate market for sure. Although, again, those stocks, they're really doing pretty well, Katie.
All right, Abigail Doolittle, thank you so much. And joining us now to keep the conversation going, I'm thrilled to say, in a Bloomberg exclusive, is Zillow Group CEO Jeremy Wacksman. And when we say new CEO, we really mean brand new. You started on August 7th, and the reception from the sell side was very positive. This is a quote from Benchmark's Daniel Curnow saying that the CEO role transitioning to the man behind a lot of the underlying platform improvements and acquisitions. So there you have it. But with that being said, I'm curious, why now for Zillow for this change, and what's on your to-do list?
Why now is because the business is doing so well, and we're excited about the strategy ahead and the growth into the future. We laid out a transaction strategy, moving Zillow from an advertising company to one that is more focused on helping people actually buy, rent, and sell with Zillow and our partners a few years ago. And you're seeing the results of that strategy really bear out. Right, the last 8 quarters, we've outperformed the residential real estate industry. We just reported Q2 results. that were 13% on the top line year-over-year growth, and we expect to grow similarly in Q3. And so you're seeing the results of that strategy work and work well as our housing super app, this integrated transaction, really gets into the hands of more customers. And so that's why we all felt so comfortable with this transition taking place now, because we're so excited about the future ahead.
So we've covered a lot of CEO transitions, especially in the last couple of weeks, it feels like. And it's not often that we hear that the role's transitioning because the company's doing super well. And, looking through your earnings, your recent earnings, that definitely appears to be true. But then you take a look at the stock price for performance. I'm going to pull up 5 years here. Of course, you had definitely a boom during the pandemic, one of those stocks that really caught on fire. You're down about 72% from that all-time high that you reached in February 2021. How much is that on your mind? When you think about your goals now in this role officially, do you want to get back to those heights?
Our goal as a company is to grow our share of transactions. Many of us use Zillow every day. We love Zillow. We're on Zillow dreaming. And most of America knows us for dreaming and shopping. But very few folks who are on Zillow actually transact, actually work with our premier agents, our agent partners, get a loan from Zillow Home Loans, use our software and services and our great agents. That's our goal, is to grow our share of transactions. Our target is just 6% of transactions by the end of 2025. And our audience share is in the 60, 70%. So our goal is really to convert more of that audience into folks who want to and can use our services to buy and to sell their homes and to rent and find their next place to rent. So that's really our goal and our focus. And if we do that, we know revenue will grow, we know company value will grow, and the company will be a bigger company over time.
Jeremy, it's no secret that when you are looking at a home in America, in many places, you're looking at a very short supply. You're looking at really high housing prices, let alone still relatively high mortgage rates if you were trying to buy a new home, move out of your existing home. So what does it take for you to make that translation, to get people to buy more homes? Is it expensive on your part also to really double down on that marketing to get people to choose you?
The housing market is challenged, especially for first-time home buyers. As you said, mortgage rates are high, which has squeezed their affordability, and home prices have come up sharply from pre-pandemic levels while inventory remains low and folks are locked into their lower mortgage rates. That makes it a tough market out there. That said, people still need to move. And so while home turnover is at near all-time lows, a little more than 4 million seasonally adjusted from a norm of 5.5 to 6 million homes that trade a year, folks are still moving. And those folks are starting their home search more and more online. They're looking for ways to do things more digitally. They're looking for ways to take a tour, press a button, schedule a tour the way you'd book a restaurant. They're looking for ways to get pre-approved digitally. So building the services for folks who can get it done sets us up well to help more of them when it gets easier for folks to actually buy and sell.
Have to ask also about the changes in the industry, just even at the granular level. There's this idea here now that the industry could change pretty meaningfully as commissions change as well, new rules around commissions. How do you expect that to play out?
Yeah, the changes that came as a result of a settlement, right, in the industry, we see as evolutionary, not revolutionary. And those evolutionary changes are great for consumers. They're really about helping buyers and sellers get more educated. Now, every buyer has to sign a contract with their agent, whereas before they might have or they might not have, depending on who they worked with. That's going to lead buyers to understand how the process works, understand what things cost.
But Jeremy, what does it mean for you? Can Zillow be making any changes to kind of lean into these new changes?
Absolutely. One of the big things we did as the settlement came out was we pioneered an agreement, a buyer's agreement with our agents. And so we led what we call a touring agreement. Our big focus is ensuring that buyers and sellers are in control and are empowered. And so it's really important for us to make sure buyers can make a choice, that they're in control. And so when they sign an agreement, maybe you sign a non-exclusive agreement first as you're shopping around and finding an agent before you move from dating to getting married to an agent and you sign an exclusive agreement. So we led the industry to pioneer what we call a touring agreement so that these buyers, especially first-time home buyers, as they learn the process, they are able to make the right decision for them. They can shop around and find a great agent.
It's like Hinge for homes.
Yeah, there you go. You should patent that one. But I want to go back to the rental market because you've brought it up a few times. And of course, Zillow owns Street Easy. Mm-hmm. I have the app. I just signed a 2-year lease. I'm on it every single day for whatever reason. But when it comes to the rental market, as we continue to muddle through this kind of frozen buying market, what activity are you seeing there?
Yeah, the rentals market is almost counter-cyclical to the housing market, and there's a strong tailwind, and there's a huge need for inventory to get filled. That's what's driving a lot of growth in the rentals industry broadly. And Zillow's rentals business is really booming. It's now a fifth of our revenue. It was up 29% last quarter, and we expect that growth to continue. What's interesting about our rentals business is StreetEasy, Zillow, and some of our other brands represent the largest amount of supply for a renter, right? You are a renter, as you know, it's hard to find all the inventory. There's no national database out there. Well, we've been able to pull together the most listings, not just the big buildings, but the millions of single-family homes out there that are for rent, and that's driven the largest audience. We have the most renters coming to Zillow, to StreetEasy, to other sites to find their place. That's now what's attracting advertisers, these big folks trying to fill their buildings, and that's what's driving our revenue growth. We see that business continuing to grow. That's $1 billion+ business for us over time.
Wow.
So how do you think about the impact that the interest rate reductions would really have? At the end of the day, you're still sitting with many Americans with mortgage rates sub 4%. And so even a reduction in interest rates at this level wouldn't really help that issue. So what does the conversion rate look like as rates come down?
Yeah, I mean, every little bit helps. But I agree with you that it's going to take more than 1 or 2 rate cuts to really unstick the market, because as you said, it's really about getting those sellers who are sitting on lower mortgages unstuck and wanting to trade up. That's what helps bring supply online. And as they talked about before, it's really about builders building more inventory, because we still have an inventory deficit in this country. So bringing more supply online from those two forces will help really alter the supply-demand imbalance we have right now, and that will ultimately make it easier for buyers.
Well, talk to us about the dynamic between prices and mortgage rates. This is a conversation, actually, we were having with Barbara Corcoran just a couple of weeks ago, that when we do get lower rates, how much pent-up demand is on the other side to actually push prices higher? Yeah,
there is still really strong demand from buyers and sellers. We track seller sentiment. Are you planning to list in the next however many years? And that's at an all-time high for how long we've been tracking over the last 5 or 6 years. And that just shows you how much folks have been staying in place, waiting for the ability to move. And the buyer demand that we see on Zillow and in the industry broadly is still at very strong levels. So even as we get more inventory and affordability eases, you're going to see it push demand even higher, which I think will keep home prices elevated.
I hear really mixed things when I talk to real estate executives about the Biden administration's policies towards the housing market. You have Kamala Harris now, as she seeks the presidential election, proposing new home supply. People love that, but they don't love the rent caps. How do you think of these policies?
Yeah, the great thing about working at Zillow, we've been around for 20 years and we've worked with whomever's in the White House. The big challenge is on affordability, and we're really focused on consumer education. A big part of affordability is making sure people make the right decision for them, get a mortgage they can afford, make the right decision, and work with a great agent. The larger macro issues around bringing more inventory online and unsticking sellers need to flow through for the market to get back to those levels you talked about. We're down at 4 million homes trading right now, which is close to an all-time low.
Jeremy, we thank you so much for joining us here in studio. Of course, 20 days on the new job, though a Zillow veteran, of course. That is Jeremy Wacksman of Zillow. Now let's get a check here on the markets, because we've had a choppy trade this morning. We are back in the green and at a higher degree now. S&P 500 now up more than 1/10%. NASDAQ 100 getting a lift of 0.3%. 10-year yield only hanging at around 384. A slight tick lower in yield, slight bid in that bond market at this point in time. Now, coming up, we're going to talk about the NFL holding a vote today that could open the door for private equity to get in the game. It's the last major league to do so in the United States. We're going to speak to Mark Patricof, Patricof co-founder and CEO, up next. This is Bloomberg. And it's time now for the Wall Street Beat. The NFL is meeting today in a highly anticipated vote on whether to allow private equity firms to buy stakes in football teams. It's the last major league in the United States to allow for this type of institutional investor to buy in. The NFL is also expected to soon announce its list of private equity partners, and it's a list that may include, according to Bloomberg's reporting, Ares Management, Arctos Partners, and Sixth Street, plus a consortium that may include Blackstone and Carlyle as well. We're going to discuss the ramifications now with Mark Patricof, whose firm Patricof Co. counts football giants Travis Kelce, Joe Burrow, and J.J. Watt as clients. And you see this from the perspective of the players. You yourself are a large investor. How do you think this is going to play out at the end and maybe change the game?
Well, it's certainly going to change the game. I mean, the NFL, if you think back to the beginning of the league, it was owned by wealthy people in smaller markets who had made their money during the industrial age, really, if you go back that far. And these owners had to change the type of person, the way they thought about the league as the appeal grew and the market grew and the revenue grew. So now you think about, and it was inevitable, by the way, this had to happen, these valuations. I think we read that Jeffrey Lurie wants to sell 10% of the team at a $7 billion valuation. What individual wants to put up a $700 million check for a business where he will have no control, no path to ownership, et cetera? So institutional ownership was inevitable. The question then is, once they come in, how do they get out? When do they get out? Since these funds typically hold their investments for 5 to 7 years, who will be next to acquire their stake at those crazy numbers? And it seems to me that inevitably this will be a publicly owned industry, which can be a very good thing. It'll address some of the lack of minority ownership issues, perhaps on the board level and so forth. So, the league is going to change. And by the way, change isn't a bad thing necessarily, but the owners are no longer really wealthy enough to own these assets, or certainly they're not liquid enough.
Mark, let's talk about that liquidity, because the idea of an IPO of a football team, there are ownership structures out there that would hint to this being possible. The Packers, for example, has more public ownership. It's not like listed on the New York Stock Exchange. But do you think that you might see some in the near future? What type of time horizon do you expect that to start happening?
You're going to see it next. There's no other way around it. I mean, how many billionaires are there out there who are willing to mark up a private equity fund's investment? So, you'll have these 6 or 10 funds. They'll put each sort of $500 million, say, per team. That will help fund new stadiums, practice facilities, guaranteed contracts like the one Watson got with the Browns. They had to put $240 million in escrow. If 95% of your net worth is tied up in your team ownership and it's a liquid, how do you fund the evolution of the business? So, the private equity funds were a natural next step, and the way they'll get out of these deals, I think, will be through the public markets, which, as I said, earlier, I think is a really good thing in some respects. Over 50% of the NFL is minority, the players. We have no minority ownership, no controlling ownership. That's probably hard to address with only a couple dozen black billionaires around the world, and none of whom seem to be ready to step up and buy a team or interested. So, board representation will also perhaps mirror the community in which these teams play. So there are a lot of good things that could come from it, but it will not be such a closely held asset in a kind of foreseeable future.
Right. Yeah. Well, it'll be fascinating to see how that evolves. And I certainly look forward to covering that brand of IPO. It sounds like a lot of fun. But I am curious, based on your conversations, of course, you work with over 200 professional athletes. Many of them are football players. How do the players feel about what we're talking about when it comes to private equity ownership here?
Well, what's interesting is put private equity aside. Over the 6 years I've been doing this, we've advised over a dozen players on buying stakes in soccer teams, in different leagues, in women's leagues, in sports that are kind of adjacent to the NFL, with the idea in some cases of learning how to be an owner. So down the road, they can actually step up and be owners themselves. I'm curious, though, as you think about some of these larger funds and these players making more and more money, some of whom are investors in these funds now, how that will impact life going forward for the NFL. I mean, all the rules are going to have to change. It's conceivable that if an NFL quarterback plays until his 40s and has made $500 million, $750 million in the field, that some of that money will be put into private equity funds, either through our deals or directly into the funds. And those funds will then be owning teams, perhaps teams they're playing against. So just like gambling has caused a lot of chaos in the NFL, for sure, this is going to cause chaos too. But at the end of the day, these assets are just too valuable to be owned by one person, and it's just a natural, course of evolution for the league.
And it's a good point there that you make about, there will be issues to sort through here. And I mean, I'm curious, when it comes to the players themselves, would we expect to see salaries rise as if this goes through, where private equity can buy stakes if we're talking about teams going public? How does that work potentially?
I mean, look, the salaries, I think the pendulum has gone from the owners being completely in control and making the vast, vast majority of the economics over the last, 50 years of the NFL, and it's swinging back towards the players. It's gradual, but if you look at the salary structure now and look at the amount of money, especially the quarterbacks with the wide receivers and other, pass rushers, that's going to continue to trickle down, and the players are going to get paid more and more as these valuations go up. As they get paid more and more, if they get paid more and more, they have more net worth to use to invest in the logical things that high net worth people invest in. Usually, it's an asset class that you understand and have an ability to impact. So, team ownership makes a lot of sense.
Mark, I want to ask you another question here, because before you started Patricof Co., you were a very prominent media investment banker as well. And now you see two football stars, two people you've worked with closely, Travis and Jason Kelce, inking a $100 million deal with Amazon. That is a third of what Amazon paid for Wondery, okay? When you see these kinds of deals, what do you think this means in terms of the potential for media rights in sports and these athletes to more directly monetize their value?
Well, first of all, I love the Kelce brothers, and when I met them 6 years ago, they have such personality and combined with great intellect, combined with both of them being Hall of Fame players, and the Taylor Swift effect certainly had an impact on this. But I think of it a little bit differently. I think of it more as you have Amazon, you have Apple, you have a new set of media, distribution partners who have other ways of monetizing those assets. So when you have personalities of that scale, the league has gotten so popular, both domestic and now internationally. There's a reason why they play games in Mexico City and Frankfurt and Munich and London. The ability to recoup the investment that media companies would make in personalities like the Kelce brothers is obvious, and it will continue to spread. But you still have to have the core ingredients that those two have, which is to actually attract an audience that and be entertaining and smart and so forth. So, but the cream rises, and the personalities will get paid. And as the rising tide lifts all ships. If you're good at what you do on the field and you're good at what you do off the field, there are partners now who will pay for your time and attention on media platforms. It makes perfect sense.
I think it makes a lot of sense. I mean, I think it's telling that I listen to New Heights very casually, and I know next to nothing about football. So there you have it, Mark. We have to leave. They're very good. They're funny, and the Taylor Swift effect. It's real. Mark Patricof.
They're authentic. Those two are authentic, and people can see that now.
Yeah, the personality definitely shines through there. Mark, have to have you back soon. Really enjoyed this conversation. That, of course, is Mark Patricof. Now, coming up, the market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg. All right, let's get to the Trading Diary. What you need to be watching this week. And today, we get Nordstrom earnings after the bell. Tomorrow is the biggie, as we keep saying. Earnings from NVIDIA finally, and more retail earnings from Kohl's, Abercrombie & Fitch, and Five Below. Thursday, some eco data. We get initial jobless claims, followed on Friday, that July PCE inflation data. We know the Fed will be watching very closely, and of course, market participants as well, Sonali.
Is it bad that I still feel like the Amazon Kelce news is the biggest news of the week? Anyways, check on markets here. We are in the green now. Let's hope it holds for the rest of the day. Of course, we started lower, ending a little higher for this show at least. 0.1%, a little more than that on the S&P 500, 0.3% on the NASDAQ 100. But the big moment, of course, Katie's tomorrow with
Absolutely. NVIDIA, of course, we're waiting those earnings, as to Abercrombie & Fitch. And speaking of, coming up tomorrow on Open Interest, Fran Horowitz, she is the CEO of Abercrombie & Fitch, joining us again in the C-suite. Looking forward to that conversation. Of course, Abercrombie shares have been absolutely electric over the past year. But that does it for us for now. This is Bloomberg.